Hold on, waiting for the button here. I think is it recording? It is recording. We're
My
starting.
end is recording. So, all right, let's just be on time and be respectful of everybody's time. Good afternoon, everyone, and welcome to today's webinar on Proposition 19. My name is Kateryna Davydova. I'm a broker with Compass. I'm excited to partner up today with our speaker, Larry Pon, to discuss this interesting topic. He is a certified public accountant, certified financial planner, and accredited estate planner in Redwood Shores. And Larry will help us today to get a better idea of how Proposition 19 will affect you and your family. And without much ado, Larry, I would like to give you the stage, and just a quick reminder to the audience, if you do have a question, then please feel free to use the chat function, and then we'll do our best to answer all the questions received. And also Larry will share with us the link to the handout material of the presentation.
Okay. Well, thank you, Katerina. I'm gonna put in the chat link here um, the Google Drive link to the handout. So we'll have a copy of this. Oops, that's not the right one. All right. So give me a second here. Actually, you know what? I'm going to do it at the end because my screen is kind of occupied with this presentation. Um, so anyway, just you can either hold on or you can ask Katerina for an email or something like that. Okay, very good. Uh, I saw a question from Mara here. You just sent a question to my email. I'm not going to see it because I can't see my email while I'm doing a presentation. So don't send it there because I can't see the question. Send it via the chat. So good afternoon, everybody. Thank you for coming, and thank you for uh, talking about Proposition 19. So it's a pretty hot topic, very hot topic. We're getting a lot of questions about it. And there's a lot of unfortunate misinformation about it too. So I hope we're going to dispel some misinformation and also understand what the new law is all about and what you should consider doing. So let's talk about Proposition 19. So Proposition 19, the official name of the law is the Home Protection for Seniors, Severely Disabled, Families, and Victims of Wildfire or Disaster Act. So that's the official name of the law. And if you recall, when we saw the TV commercials during the political campaign about Prop 19, we saw the hunky fireman who talks about how this new bill is going to help pay for firemen and all those good things and all that, but not the stuff we're talking about today. So that's kind of way how campaigns work. So on November 3rd of the election, it passed 51% yes for almost 49% no. So it was narrowly passed by the voters of California. Now, Prop 19 has two parts to it. So there's two effective dates. The first part takes into effect on February 16th of 2021, just a short time from now. The second part takes into effect on April 1st of 21. So there's two parts. And Prop 19 is a constitutional amendment to the California Constitution. Because it's been voted by the voters of California, it does change our Constitution. And the government agency that's going to be implementing it is the California Board of Equalization. So that's the agency that puts out the rules and gives guidance on how Prop 19 is going to be enacted. But locally, it's being enforced by our local property tax assessor, and that's from each county. So each county, we have our own tax assessor. So that's basically how it works. So let's talk about the first part of it. So the first part about Prop 19 is what's called increasing the portability of your property tax assessment. So Prop 19 expands the base year value transfers. So it applies to anyone over age 55 and victims of wildfires and natural disasters. So it expands that. That's the good part about Prop 19. Under the current law, you can only do that once in your lifetime, once per lifetime, and generally in the same county. So if you're in San Mateo County and you want to take your assessed value to another home, it's got to be within San Mateo County or in the 10 counties that permit intercounty transfers. and I don't have that list memorized. I always have a post-it in the book of where those counties are. But yeah, I always have to check the website to see which counties are in that inter-county transfer because it keeps changing. Some counties get added, some drop out. So you always have to check that list before you make a big decision. So San Mateo County, Santa Clara County, Los Angeles County, those are the bigger counties that come to mind that allows this portability. And generally the purchase price of the replacement property is equal to or less than the sale price of the original property. So equal or lesser value. It's for people who are downsizing. Our kids are gone. We got this big house now. We want to downsize. So the California law allowed you to take that assessed value to a less expensive home. So Prop 19 removes that barrier to the portability, and that part of the law takes into effect on April 1st, 2021. April 1st, 2021. So you're allowed to do 3 transfers per lifetime if you're over age 55 or disabled, or if you're a disaster victim, you have unlimited times to do this. And sadly, we've had quite a few disaster victims up in Santa Rosa, Sonoma County, Napa County, Northern California. And what Prop 19 does is that you can go from any county, from San Mateo County to San Francisco County or any county you want now. So that's wide open. And even where the purchase price of the replacement property is greater than the sales price of the original property. So if you get a more expensive home, you can still take your assessed value. However, you need to calculate the new taxable value. It's going to be the original property plus the difference in value between the sales price of the original property and the sales price of the replacement property. So we'll have an example in the next slide here. So the form you file is BOE 60-AH. That's for people at least age 55. And then BOA 62 is for a disabled person claiming a transfer for base year value to replacement dwelling. So here's the example of a higher fair market value. So let's say you sell your home for $650,000 and the assessed value is $400,000. And you go find a new home and the new home is $750,000. So under the old law, before Prop 19, you don't get to carry the assessed value with you. So your assessed value goes from 400,000 to 750,000 for the assessed value of the new home. Under Prop 19, the assessed value is 400 plus the additional value. So it's 750 minus 650, that's 100. So 400 plus 100 equals $500,000. So that's the assessed value in a new house. So you pay property taxes on $500,000, not $750,000. So that's what Prop 19 does for you. So let's talk about reassessments. So there's 2 instances that would cause your property to be reassessed. First is could be new construction. You have new construction in your home. You add an addition, you add a floor, new construction. We're not going to go to detail on new construction here because that's not the point of this webinar, but that's definitely one thing that can cause a reassessment to your property tax value. But most importantly, is when you have a change in ownership. Whenever it's a change in ownership, that's when the county can reassess the property tax value of your home. So for example, let's say we bought our home back in 1970 and so the assessed value of this house is $185,000. And so what's the property tax? An enviable $1,850. You only pay $1,850 property tax on this house. And the house is worth $1,050,000. So this could be your parents' house or someone like that who bought it a long time ago, and the assessed value is 185. Now it's $1,050,000. And so someone buys your house, someone else buys your house. There's a change of ownership. The assessed value is now $1,050,000. So the new owners are paying $15,000 property tax on this same house. Nothing's changed. It's just that it's a change of ownership. And, locally in our school districts, all the business superintendents know all the low property tax value homes in their districts. They all know that. And then they keep really close eye on whenever there's a sale. They keep an eye on the sales of those homes because they'll know that, great, our school district's going to get a little bit more money now because that house finally got sold. Its property taxes are going up. So we'll get a piece of that. So that's what happens whenever it's a change of ownership. However, Proposition 58 was passed in 1986. So since 1986, when a parent transfers the principal residence from parent to child, there's no reassessment, no matter what the value of the property is. It could be the example we had before where you went from $185,000 to $1 million. No reassessment. It goes the other way around too. If if a child transfers a property to a parent, no reassessment. That's what Prop 58 says. And it doesn't matter what the child or whoever receives the property does with the property. You don't have to live in it. They could turn into a rental property. And also, you can transfer up to $1 million in assessed value of properties that's not your principal residence without reassessment. So these are typically rental properties, second homes, or vacation homes. So up to $1 million of assessed value. So if you have two spouses, a husband and wife, that's $2 million. So if it's non-residential property, you can transfer it up to $2 million of assessed value, not the fair market value, but the assessed value. So that's the way the law is right now until February 16th. So, like I said, if it's a married couple, each spouse can transfer $1 million in assessed value to their children without reassessment. So it's only parent-child. Can't be siblings, nephews or nieces, or grandparents. Now, there is a grandparent-grandchild exclusion only if the parents are dead or deceased. So if it goes from grandparent to grandchild, if there are no parents. So that's the only thing there. Well, sounds like a great deal, right? Sounds like a real good deal. And there's a New York Times, LA Times article called the Lubowski loophole. It's a story about Jeff Bridges. He and his siblings inherited his parents' Malibu home. Lloyd Bridges, right? Lloyd Bridges, the famous actor. And so they had a home in Malibu, and so Jeff Bridges and his siblings says, hey, we're not going to move into it. We don't need to move into it. It's a beautiful house in Malibu. They're renting it out for $17,000 a month. So they're collecting $17,000 a month. And the property tax on the house was $6,000 or so. So for $6,000 a year of property tax, they're getting $17,000 a month. And so this reporter called it the Lubowski loophole. And one of our folks in Sacramento, our politicians in Sacramento heard about that. They read this article and they go, why is there a Lubowski loophole? We better close that loophole. Hence, we have Prop 19. So thank you, Jeff Bridges. Thank you, Jeff Bridges. So now, because of him, we have Prop 19. So what did Prop 19 do? So Prop 19 substantially changes it. Prop 58's out the door. So starting February 16th, Prop 19 kicks in. And so what it says is that the limit on a transfer of property from parent to child, as long as the child uses a principal residence, is the value plus $1 million. Value plus $1 million. So for the child to keep that assessed value, the child has to claim a homeowner's exemption, and they got to do it within 1 year from date of transfer. So if you want to keep the same assessed value, the child has to move into it, make it a principal residence, no later than 1 year of transfer. And only the principal residence is eligible for this. So what Prop 19 does is does away with the non-residential transfer rule where it's up to $1 million assessed value. There is no exclusion for other real property. So there's no exclusion for vacation homes, second homes, rental properties, any other properties. So that's what Prop 19 does. So let's say it's you want to take advantage of this exception. So my recommendation is to get a qualified appraisal. So if you're a child inheriting your parents' home and you want to take advantage of this parent-child exclusion under Prop 19, I highly recommend getting a qualified appraisal. You call an appraiser and say, hey, look, my parents are giving me this house. It could be either inherited, it could be just given to you as a gift, or the child could buy it from the parent, whatever way it gets into the child's hands. But I highly recommend getting an appraisal, because if you don't put an appraisal, get appraisal, the county will make up their number. And there's a good chance you might not agree with what the county says. And this starting in February 16th of 2023, this $1 million cap will be adjusted for inflation, but using the house price index, the HPI for California from the prior year. Well, the HPI is not the CPI. The CPI is the consumer price index, and that's relatively steady. It's relatively steady. The HPI bounces all over the place because the real estate's pretty volatile. California real estate's volatile. It goes up, it goes down, it goes up, and it goes down. If you look it up, you can look at the graph. There are some cases where it was negative 13%, and there are some cases where it's positive 25%. So we don't know. So 2023 is when that $1 million cap's going to be adjusted for inflation. Um, what it doesn't say is this subject to deflation? So what if it goes negative? Does that mean that $1 million gets decreased? That's one of those unanswered questions we're waiting for an answer to. So that's something you got to look out for. So let's go over an example of this. So let's say the parents have a principal residence. The assessed value is $1.5 million. And the market value of this house is $1.8 million. So the parent transfers the home to the child. So, hey, kid, here's the house. And the child moves into the property as their principal residence. So the child files a homeowner's exemption declaring that it's their principal residence. So the assessed value for this child is still $1.5 million. No property tax increase because 1.8 minus 1.5 is $300,000. $300,000 less than $1 million. No reassessment. So let's take a look at example number 2 here. So same house, except assessed value is 1.5, but it's worth $3 million. So let's say this house is worth $3 million. So after the transfer, the child moves into the home, uses as a principal residence, file homeowner's exemption. The assessed value is now $2 million. So how do we get there? Well, we take the 1.5 million, which is assessed value, plus the $1 million cap. So 1.5 plus 1 million is 2.5 million. Then the value is 3 million. 3 million minus 2.5 is $500,000. So we take that $500,000, add it to the $1.5 million assessed value, equals $2 million. Equals $2 million. And so the property tax is going to be from $15,000 to $20,000 in this example here. Let's go over one more example. Example number 3. So we have a house with assessed value of $1.5 million. The market value is $3 million. The parent just gives the house to the child, but the child doesn't move into their property, decides to turn to rental or whatever. The assessed value is $3 million because the child's not using it as a principal residence. So instead of $15,000 property tax, it's $30,000 now. So it's got to be used as a principal residence to be able to take advantage of the previous assessed value. So let's see, we go to number 4 here. Let's see. So in this example, $1.5 million assessed value, $3 million fair market value. The assessed value to the child is $3 million because the child doesn't move into it, and you got the increase. But because it's a rental property, it doesn't matter. It gets reassessed whenever there's a transfer. So it doesn't matter. It doesn't even matter if the child moves into it as a principal residence because it was the parent's rental property. So if we're going from non-principal residence, it's going to be reassessed no matter what. So whenever there's a transfer of property, it will be reassessed. Okay. All right. Kateryna, do we have any chat questions or anything like that, or any Q&As? I don't.
I believe we have a few questions. Let me just.
Okay, I think this is a good break for that. And
okay, so there is one question, and I can read it to you. When a property is reassessed to market value, does the depreciation schedule, example, if property taxes rise, does the deductible amount for depreciation increase too to offset the taxes?
Okay, I'm going to go over that question later because I have an example of that. And then Christine's got a question here.
Yes.
With Prop 19, for transfer from parents to children on the home, what if there are more than one children? Is only one child required to move into the home? Okay, that's one of the questions we have. There's a number of unanswered questions, and that's one of them. And so what we're hearing from the assessors is that if it's multiple children, then whoever moves in, that portion will retain the former assessed value, and the ones who are not living in there will have a reassessment. So that's the word we're here right now, and I'm sure we're gonna get some more guidance on it, and we'll talk about that guidance later here. All right, very good. So let's talk about some tax consequences here. So here's a common question we're getting right now, right? Because Prop 19 is going to take in effect on February 16th. If I transfer my property to my children now instead of waiting until I pass away, what tax consequences do I need to be aware of? Of course, we got property tax consequences. Well, not just property tax, right? That's what Prop 19 is all about, but we got income tax, gift tax, and estate taxes. So welcome to America. We have a lot of taxes and we got to deal with them. Okay, so Prop 19 for property taxes is based upon the assessed value of the property, like we were talking about, the assessed value of the property. And that's the number you see on your property tax bill. It says the assessed value. And because of Prop 13 back in 1978, our increase is capped at around 2% a year or so. So that's why you might start with a low property tax. It goes up 2% a year, not due to the value of the increase of the property. So it's not the same as market value. Market value can be substantially higher than assessed value. So a lot of people are thinking about, how about circumventing Prop 19? If the property is already owned by the children before February 16th of 2021, there's not going to be a reassessment when I die. That's true. You're circumventing Prop 19. So just to recap on the current law here, there's two exclusions from reassessment that can apply between parent and children. Got the principal residence exclusion that we talked about earlier. Then we get the $1 million lifetime non-principal residence exclusion transfer between parents and children. So this applies to second homes, vacation homes, rental properties. For a married couple, that's $2 million. Now, just to clarify on that, because it's $1 million of the assessed value of the property. It's not $1 million among the kids. So you can't say, oh, I'll give 200 to this kid, 300 to that kid. And no, it's based on the property, not on the person. So you gotta be aware of that distinction there. So Prop 19 applies for transfers on or after February 16th of 2021. So to qualify for the principal residence exclusion, the receiving child must use the residence as their own principal residence, and only the first $1 million additional assessed value is excluded, like we showed in the example earlier. And non-principal residence exclusion has been completely eliminated. So the principal residence exclusion will apply to transfers. There's an exception for California. Principal residence exclusion will apply to transfers of family farms. So family farms still get that treatment. And transfers that occur before February 16th will not be reassessed after a new law is enacted. Okay, what does this mean? If you're going to transfer to your kids, or if you want to do that, don't wait till February 16th. February 15th is a holiday. So your effective real date is February 11th. And we're under a COVID situation here. So you can't just show up to the assessor's office with your paperwork saying, here you go, because if you go to the office, it's most likely closed. So plan carefully. You can put in the mail, but that's too dangerous. Because they probably get stacks and stacks and stacks of mail in one central location for the county. So there's no guarantee it'll get to the assessor's office on time. I wouldn't want to do that. So I would recommend working with a title company. A title company does this electronically with the assessor's office. So that's probably the best way to go. But again, call the title company, make sure they're open and they're available to help you with that. So there's some considerations to think about. Does that make sense? Well, you got to check with the family. If the children are not going to keep the property, if the children are likely to sell the property, it might make sense to hold on to their property. Why? Because if the children inherit the property, they get what's called a step up in basis. So we have what's called step up in basis. So for example, grandma bought her house for $100,000. It's worth $1 million now. You inherit grandma's house after she dies, the basis gets stepped up to $1 million. And 1 million minus 1 million is zero. However, If you take grandma's house now, you get what's called a carryover basis. So that means if grandma's basis was 100,000, your basis is 100,000, you sell the house for $1,000,000, you've got a $900,000 capital gain tax. So you need to evaluate this before you make these radical moves. So, if the children are not going to keep the property anyway, it probably makes sense to hold on to it and let them inherit it to get the step up in basis. Now, if the children are likely to keep the property, well, how are they going to keep it? Are they going to use it as a principal residence? Are they going to convert it to a rental property? You got to do the math to see what's worth to you. Step up in basis versus preserving the property tax base. So that's a serious income tax consequence here. So let's go over an example. Got a parent's primary residence, and they give it to their child, and the child moves into as their principal residence. They file a homeowner's exemption. So the tax base in this house is $500,000. To make the math easy, let's assume the cost base is also $500,000. The market value of this house at the time of transfer is $1.3 million. So the market value minus the tax base is $800,000. Well, in this case here, if you do this after Prop 19, since 800K is less than $1 million, there's no reassessment upon transfer. So the tax base stays at $500,000. So let's say this child decides to sell the house. You gave them a house. They don't wait for an inheritance. They just take the house, they sell it. So 1.3 million minus 500,000 equals an $800,000 capital gain. So this child would pay tax on $800,000 of capital gain. So let's say the child lives there for 2 years to take advantage of what's called Section 121 exclusion, which is a $500,000 exclusion. They live in there for at least 2 years. So then it's 1.3 million minus $500,000 for the cost basis minus, in this case, it's a single child, $250,000, 500 for married, 250 for single. So we have a $550,000 gain. So this is what happens if the parents just gift the house to the child right now before they die. Well, let's say the parent doesn't transfer the property to the child right now, but the child inherits the property. So there's no change to the property tax base because the child moves into property and uses it as a principal residence. And also the increase is less than $1 million, same $500,000. But let's say the child, it's not the right house for me. He decides to sell it. Well, it's stepped up to 1.3 million. Let's say we sell it for 1.3. 1.3 minus 1.3 equals 0. No capital gains tax. No capital gains tax. Well, let's say this child inherits this property, but doesn't use it as principal residence. Well, if it's not used as a principal residence, it's reassessed to market value. So the property tax base would then be $1.3 million. So that's our example here in this case. So let's go to a rental property. So we have a rental property, $500,000 assessed value. The property tax is $6,000. Cost basis is $500, and the depreciation is about $7,000 a year. And I think that was Maura's question there about the depreciation. So let's say the fair value is $2 million. If the property gets transferred now, there's no step up in basis. No step up in basis. So the basis stays at the $500,000. Depreciation stays at $7,000. However, you wait to inherit the property, you get the step up in basis. Now it's $2 million. Look at the depreciation deduction. Now it's $36,000. $36,000 versus $7,000. The increase in depreciation deduction is over $29,000. True, the property tax is now $20,000. Used to be $6,000, it's $20,000. So, yes, you're paying more in property tax, but then with the step up in basis, you have a higher depreciation deduction. What's a depreciation deduction? That's a deduction you get for owning rental property that's offsetting your rental income. That's the tax shelter against your rental income. And I'm not sure how much this house will rent for, but whatever it is, $36,000 of that is sheltered by depreciation. And for residential rental property, that's depreciated over 27 and a half years. We're going to get that over 27 and a half years. Now, if you make subsequent investments in a property, if you put furniture or fixtures in there, appliances or whatever, that's going to be additional depreciation deduction. And under current law, we have something called the bonus depreciation. let's take a look at another case study here. So this is an interesting example. This is an example where father and daughter owns a house 50-50. So what the father did was he had this house, and when he refinanced it, add his daughter to title to this property. So it's called a refinance transfer. And it's a interesting way of doing that. And refinance the house. And the deal is the daughter now pays the mortgage. She pays all the property tax. It's basically her house. She's living in there, but on the title, it's 50-50. So let's say the assessed value of this house is $500,000, and the current fair market value of this house is $1.5 million. Well, if you were to transfer a property now before Prop 19 kicks in, there's no reassessment because it's going parent to child. It's parent to child. There's no reassessment. However, no step up in basis. No step up in basis. What if she just waits? There's no rush. She keeps paying off the mortgage and all that. And after Prop 19, there's no reassessment because the increased value is still less than $1 million. In this example here, let's say the house is, by the time dad dies, it's worth $2 million. Well, 2 million divided by 2 for 50% is $1 million. And so, she'll still get the stuff on basis, and it's still less than $1 million increase in value. So in this case here, I told them, hold off. You don't need to transfer a property now. It's better for your daughter to get that step up in basis. However, let's monitor the situation. Keep an eye on what the value of the house is. And I think the magic number is 2.5 million. So if it gets over $1 million, if the house gets over $1 million, I think that's the time when you want to do the transfer. Do it at that point, but don't do it now. Who knows? I don't know if this house is going to be worth more than that or not. It's just something to keep an eye on. So when someone asks me this question about should I transfer to the kids right now, well, it depends. You want to give this up for that or whatever, and we'll talk about some more consequences to think about. So we talked about the income tax consequences, step up in basis and all that. Now we got the gift tax consequences. We got to be aware of the gift tax consequences because in the United States we have many kinds of taxes. We have income taxes, not just U.S. income taxes, we have state income taxes too, right? So we have federal and state income taxes. And then we have what's called gift and estate tax. It's called a transfer tax because you're transferring property from one person to the other. Now, what's the difference? In the U.S., we have what's called a unified tax. It's the same tax. It's just that it's called a gift tax if the donor's alive. It's called an estate tax if the donor's deceased. That's the distinction. Alive or not alive. So that's when do I have a gift or do I have an estate tax? So gift tax, so if parents are transferring properties to the kids, they got to consider the gift tax. Now, there's a $15,000 annual exemption per donee. So if you have husband and wife, that's 15 times $30,000 they can give to their kid without worrying about any gift tax reporting. Now we have the annual exclusion, then we have the lifetime exemption, also known as the basic exclusion. For 2021, that number is $11,700,000. For a married couple, that's times 2, that's $23,400,000. So if you gift more than $15,000, you got to file a gift tax return Form 709. And the IRS agents for our area who audit these things are all in Oakland, and they're all lawyers. They're all tax lawyers, and I met quite a few of them. I always ask, where you're from. Just to give you a hint, the IRS is not hiring straight out of school, so you're not getting newbies. You're not getting people right out of school. These people all have worked for law firms, so they finished the law school. And some of you have a master's in tax, an LLM in tax, so they have advanced training in tax, and they work for a law firm. So they're pretty on top of things. So, they're hiring pretty experienced people. So they know their stuff. So here's an example here. A parent gives the child the home, and so you got to report that on the Form 709, which is the gift tax form. And the gift is 1.3 million. How do we back that up? We get an appraisal. We ask an appraiser to give us an appraisal. Okay, so the appraiser says 1.3 million. So let's say we give it to one child, one parent. So 1.3 minus $15,000 for the gift exclusion, assuming there's no other gifts. The taxable gift is 1,285,000. That taxable gift is applied against a lifetime exclusion. So 11,700,000 minus 1,285,000 equals 10,415,000 left over going forward. And the gift tax is 0. So you will pay gift tax when you go above that. Back 10, no, yeah, more than 10 years ago, uh, the exclusion was $3.5 million. And before that, it was $1 million. And before that was $600,000. So in my practice in the past, I've had parents give their parents, I had parents give their children homes and they had pay estate tax. I mean, I'm sorry, gift tax. They had pay gift tax because we didn't know that they were going to raise the exemption amounts. So we did have taxable gifts, but we probably don't see them now. But it's still important that you file them because the lawyers in Oakland, they monitor all property transfers because it's public information. So it's at the county recorder's office. They monitor it every day, literally every day. They'll just get the printout from the computer, and then they'll have that on their list there. Then they'll check the computer to see, has anybody filed a tax return for it? If there's no tax return, you're going to get a letter. Okay, so try to avoid that letter because they're going to ask you a lot of nosy questions. Better to prevent than to fight. Okay, that's gift taxes. Now let's talk about estate taxes. So that's after you pass away, estate tax. So if the parents hold on to the property, it's still part of their estate. And if their assets are more than the exclusion amount, 11,700,000, they'll pay estate tax. Currently, the estate tax is at 40%. Now, I know there's some talk about the possible changes under the Biden administration, and one of the areas they're looking at is estate tax changes. What's going to happen? We don't know. However, what do we know? Um, the Tax Cut and Jobs Act doubled the basic exclusion to 11,700,000. That's what it is now. And on January 1st of 2026, it'll be cut in half. So it'll be half of this amount. So probably by then it'll be $6 million or wherever the number is. There's a possibility that date might be accelerated. There's a possibility estate tax might be 45%. So there's some things we have to keep an eye on what's going to happen. So we'll have to keep an eye on what pending legislation might change. We'll have to keep an eye on that. So now the form to file after the death of the spouses or anybody is Form 706, the estate tax. However, one thing that doesn't change is this concept called portability. So if you have two spouses, one of them die, I would seriously consider portability. What is portability? Portability is taking advantage of the deceased spouse's unused exemption, also known as DSUA. So what that means is, let's say we only used $1 million of the deceased spouse's exemption, so we still have $10 million left. By filing for portability, you keep that $10 million and apply it to the surviving spouse. And this assumes the surviving spouse doesn't remarry because it kind of goes away because you don't have a deceased spouse if you have a new spouse. So if they don't remarry, you have that additional amount, that additional portability. Why you do that? We do that as an insurance policy because there's some in Congress who wants to drop the exemption back to the 2009 level, which is $3.5 million. We'll see. You hear in the news, there's talk about, well, they might do away with the step up in basis. I don't think it's going to happen. It's happened twice in history, 1978 and 2010, but didn't go very well when it did. I don't think most members of Congress understand that or have the appetite for it. So maybe it might not happen. So the step up in basis is still very, very important. So when it comes to making these decisions, you want to look at the property tax savings versus the capital gains taxes. And it's not a 1-minute discussion. It's a deep analysis. And it's not a decision you make in a minute. We still got to review your estate plan, right? You want to review your estate, review the deeds to your house. There's a lot of out-of-date deeds out there, especially when you have a spouse who passed away previously and you have a surviving spouse that owns a home, but the name of the deceased spouse is still there. And I've had that happen a number of times. And the realtor tries to sell the house and then they can't because there's some legal issues with that. And so if you want to sell the house, you want to make sure the title is clean. So it's really important, right, Kateryna? You want to have clean title to the house. A lot of houses don't have clean title, so make sure it's clean. Clean title is important. Consider the non-tax consequences of transferring property. Do the kids have responsibility? I've had cases where parents gave a child a home and the child loses it. This case I was telling Kateryna about was a CPA. The daughter was a CPA. You think she knows something about finances? She lost the house. It was a San Carlos house, and I don't know how she did it, but she lost the house. Or the child has to be drug addicted, and all his drug friends are there. Or this happened in Belmont. This house became a meth lab in Belmont, and fire, police departments, all that. It's like we have a meth lab there. That means the house can explode. Not a good thing. So, I mean, I'm not joking. You'd be surprised. I mean, can they handle owning a home? Can they handle the responsibility? What if the parents still want to live there? Are they going to kick them out? What if you have a blended family? Which mom, which dad, which mom? I don't know. That could get kind of confusing, right? Blended families, that can be really complicated. Consult a knowledgeable and experienced advisor to review all the variables. Don't just focus on one variable. And you know, and also the person you're getting advice from, is that person going to make money off of your decision, right? Versus someone who's kind of unbiased. So you gotta be careful about that. So considerations is low property tax versus the current market value of property. What's the long-term plans for it? For some families, vacation homes, especially ones that aren't worth that much money, it might make sense to do the transfer to the kids now for vacation home. What if they don't plan on keeping the property at death of the parents? Rental property. I think the biggest deal with rental property is depreciation. That's a big deal. That's a big deal. And how's the estate allocated among family members? Who's getting what? That's kind of important. And someone asked a question about, it's like, I have 5 kids. One lives in it, the others don't. Or how do you get all 5 kids to agree on something, right? So good luck with that. And we have some unanswered questions. We have some unanswered questions that we're awaiting guidance on. So, I mean, on December 11th, there was a letter issued by the Board of Equalization of some guidance to the assessors. So someone had a question: what if the property converts to other uses in the future? Like the kid moves in as their principal resident. What if they decide to turn to rental property? I think the county would know, because you would drop the homeowner's exemption, because you can only have one homeowner's exemption. What if there are multiple children? Do they all have to live together? You got a bunch of 45-year-olds, 50-year-olds. Do they want to live together? A lot of questions here about, should I move my property to an irrevocable trust? Most of our clients probably have revocable trusts. Those are living trusts. But how about irrevocable trusts? And those are the alphabet soup of acronyms, right? You got SLATs, you got IDGITs, you got CUPERTs, and all those kind of fancy things. Should I transfer my property to an LLC? There's a lot of consequences there, right? LLC. So the tax assessors, there's the California Assessors Association. So they gave a list of questions to the state, saying, hey, we're supposed to enforce this law, and our homeowners are asking us all these questions, and we don't know the answers to. Give us some guidance. So hopefully we'll get some more guidance from the Board of Equalization. Some guidance can be done at the agency level, but sometimes they might not have the authority to give guidance. So that might mean future legislation. So our assembly members might have to write a bill or something to either correct something or clarify something. But it might even mean another constitutional amendment, which means you might see another proposition, in case there's something that's unclear or whatever. That's going to be fun, right? And lastly, are we still going to have Prop 19 in the future? I don't know. There's a lawsuit going on right now. I don't know if it's going to go anywhere, because to file a lawsuit, you have to be an egregious property, egregious family. Well, the law hasn't kicked in yet, so how can you file a lawsuit before the law kicks in? So I'm not a lawyer, but I don't know. But anyway, who knows what's going to happen? So we got to make sure you understand all the consequences before you make some big actions here. So I think that takes us to the end here. I'm going to take a look at the chat. Let's see, where's the chat? Okay, so I think for the last part of our time here, we're going to work on questions. Okay, it's just saw something pop into the Q&A here. Vic's got a question. Let's see. If a house, okay, hold on, my eyes are bad. Sorry about this. If a house is listed in a living trust and one spouse passed away 10 years ago, is there any problems on the IDs? Oh, kids. I think you mean kids selling the house when the surviving spouse passes. Yeah, this, like I mentioned before, we had this case. Actually, it's the same thing. The wife passed away 10 years ago and the family did nothing. And then the dad passed away and and now they're trying to sell the house, and then the title company says, "Whoa, the title's pretty messed up on this house. You have a couple owners who are deceased, and you guys never updated the deed and all that." So, there was an issue in getting that straightened out and all that stuff. So in this case here, first of all, you got to get the deed updated on the house because you have one surviving spouse, and two, you need to review the trust to see what's the disposition of the house upon the death of the first spouse. Is it written in a way where it goes to a bypass trust or not? So part of the answer depends on how the trust is written and whether the bypass trust was funded or not. So yes, there are some problems with selling the house when the surviving spouse passes away. So let's assume the surviving spouse passes away after February 16th and the kids don't move into the house. Well, under current law, they'll get the step up in basis. If they decide to keep the house, then the property taxes will get reassessed. All right, so my eyes are in a blur right now, Kateryna. I see a lot of chats here. So let me see what kind of questions we have in the chats.
Larry, do you want to take the question of Christine about Prop 19? With Prop 19 for transfer from parents to children on the home, what if there are more than one children? Is only one child required to move into the home?
Yeah, that's a good question, Christine, because those are one of our unanswered questions. So I'm just suspecting this, and and we can check with their assessor, but most likely it's going to get prorated. If it's 3 kids, one kid moves in, so one will one will possibly not get reassessed, and then 2/3 will get reassessed. However, if you're going to file that transfer of interest paperwork, get an appraisal. Get an appraisal, because that way you are suggesting what the number should be versus waiting for the assessor. Because, like I said, it's always better to avoid a fight, right, than to fight. Fighting is always a lot harder. So let's not do a fight. Abigail had a question about, is there a deadline to transfer to the child to the benefit? Well, if you want to avoid Prop 19, you got to get the transfer done before February 16th, so, all right. Christine has her hand up. So you can type in your question in the chat here, Christine, what your question is. Okay.
And Larry, there is Francis' question. If a child receives a property from the parents and moves into the property within 1 year, how long do they have to live on the property? If any, can they take this assessed value to a new property they purchase to move into later on?
Oh, Francis is being very creative here. So yeah, so let's say child moves into the parents' property, and I'm assuming the parents transfer title of the home to the kid and all that stuff. Okay, so you move it there. That's one of those unanswered questions, but let's assume they qualify because they filed a homeowner's exemption, and then that kid has to be over age 55, so 55 or older. Then you can take that assessed value with you to the new property later on. So you have to, it's each hurdle. So just look at the hurdles. If you can meet the hurdles, then you can take advantage of it. Again, if you want to take advantage of that hurdle, get an appraisal. Sounds like it's a good time to become an appraiser. I think there's a lot of job opportunity for them here. Let's see. Roger's got a question. If the inheriting child moves into the foreign presence home, declares a homeowner's exemption, but moves out after, say, several years, how is the property treated for property taxes? Well, the thing is, if you move out of the home, you can only have one homeowner's exemption. If you move out and it's not your principal residence anymore, you're supposed to inform the county that's no longer your principal residence, therefore no homeowner's exemption. And that's when they're going to know about it. And then the house will get reassessed at that point. Okay, is that the one we just read from Roger? Okay, and Francis. By the way, child's over 55. There we go. Okay, Mara, has there been a lawsuit filed about Prop 19 parent child transfer? Yes, there is. And to be honest with you, I haven't read it, so I'm not going to, because there's always a good chance of you can always file a lawsuit. Lawsuits can be filed all the time. A lot of them are frivolous, so I frankly ignore them until they actually get litigated. So it's a good chance you might get thrown out for lack of jurisdiction. That's what they got to look out for. Does gift tax create a taxable event for the child? Good question, Martha. So, yeah, when you're a recipient of a gift, that's why it's called a gift. So there's no income tax consequence when that happens. Okay, Ram says, let us say someone who is 68 buys a property as their principal residence. In a couple of years, he's finding difficulty paying property tax. Are there any relief that a county assessor gives to such elderly citizens unable to pay property taxes? Well, you can go to the county property tax assessor's website, and the um, what's the job title of the other person? Tax collector's website. Um, there's no relief from property tax. There's no relief from property tax. There is a delay of paying property tax, so you can apply for a delay of payment. It doesn't make it go away. You can apply for a delay of payment. Now, if you are going to be selling your house soon, so you can delay your property tax. However, it's not free. The interest and penalties still apply. So, it's not free. There's no real relief on that per se. And property taxes are about it's at 1% of the value of the property plus the add-on. So that's how that works. Will February 16th be changed to wait for pending litigation or constitutional amendment? The answer to that is no. I asked that question to my lobbyist. We have a lobbyist. I'm a member of California Society of CPAs, and we have a lobbyist. And I emailed him directly. I said, Jason, yeah, and us CPAs, we have a meeting with our legislators this coming week. So we have a meeting with our legislators. I'm in Redwood Shores, so my assemblyman is Kevin Mullen. So I've got a meeting with Kevin Mullen, and I also have a meeting with Evan Lowe and Josh Becker, a new state senator in our area here. And this is one of the topics we're talking about, because we want to let our legislators know that us CPAs are here to help you. Don't just write laws and throw them out there, because maybe they're poorly written, or we can help you write them better. So I asked him about that, and the answer is no. The reason is no is because it was voted on by the California voters, because it was a constitutional amendment brought on by the California voters. There's no extension on the application date of the law, so there's no. It's February 16th. It's written in stone because the voters have spoken. Another question, I think it's better to buy a plot and build your own house to keep the assessed value very low, because there might be opportunities for that by not listing amenities to the house, or even to skip some items of construction. Okay, I didn't go into that. This talk here is the other reason an assessor can reassess your house is when there are improvements made to the house. So, this is why we have building inspectors, and this is why we have permits and all those rules we got to follow. And it's also for safety reasons too. You want to make sure you build a safe house. You don't want a house destroy your neighbor's homes by starting a fire or something like that. So all that information is sent over to the county, so they have that information. So don't cheat, okay? Don't cheat. But yeah, one way of saving money possibly is buying a plot of land and building on it, because you'll be assessed for the purchase price of the land plus the cost of construction. Cost of construction hopefully be less than the value of the property, because it might cost you $1 million to build, but the house could be worth $2 million. So you might just get reassessed for the $1 million. And yeah, that's a great way of saving money on it. But just be careful about making sure you fill out the paperwork right. Can you talk about 4121? If you sell your house, you can take property tax. Are you able to go back to their prior home sale for 2016 and take property taxes? No, the Prop 19 on the portability amount takes an effect on April 1st. So it's only for transactions after April 1st. Okay. My house is in a revocable trust with my daughter as the beneficiary, but my husband has a life estate if I die first. Will the property reassessed at the time of my death? Okay. We didn't talk about life estates here. So what's a life estate? A life estate is, I'll give you my house. But I have a life estate in it. So I'll give you my house. But the life estate means I still get to live in the house for the rest of my life. And we've had those. I mean, I had a case where a client, she left her boyfriend a life estate. And the guy lived for another 25 years. So, so her kids didn't get that house until he died 25 years later. Oh my God. So that was a very interesting story. And the thing is, the family forgot about it. They forgot about that house. And the only reason they knew about it was because Wells Fargo was going to foreclose on it, because somehow the sons of this guy got a mortgage on the house, which wasn't legal because he didn't own the house. He only had a life estate, but somehow they convinced Wells Fargo to give them a mortgage, and they didn't pay the mortgage and they were foreclosed on it. So a life estate means it just means you get to live in the house, but title has changed. The beneficiary of the life estate doesn't own the house, so it will get reassessed, even though it's a life estate. So basically, you got a house with someone who's occupying it. That's what that means. All right, it's amazing what kind of questions we can come with. What is the definition of a farm for Prop 19 taxes? So there's a specific definition of a farm. I don't have that off the top of my head. You can look it up. You can look it up under the Board of Equalization, and they'll have a nice long legal definition for it. But you can imagine what a farm looks like, right? You might have some cows there, you might have some ranch. If you're thinking about growing some grapes in your backyard and calling it a farm, don't go there. That's not going to work. Okay, I have people try to do that. Say, Larry, I got a farm. You live in Foster City. How can you have a farm? Well, I got 12 grape plants. That's not a farm. Hey, Larry, wants some zucchini? No, it's still not a farm. Okay. Anyway. Will you be sending a slide presentation to the participants? Okay. Nancy has got something. Moving within California, how long is the low property tax good for? Can voters change it? How will my taxes go up? Well, Nancy, if you're over age 55 and you sell your house after April 1st, you get to take advantage of Prop 19. If you sell your house before April 1st, then you're under Prop 58. So it's either Prop 58 or Prop 19, depending on which way you go. Prop 60, I think I meant Prop 60. Whatever, the once in a lifetime, you can transfer things. So that kind of depends there. Let's see here. Let me post in the chat. Let me post in the chat the link to the handout. So give me a second here, folks. Thank you for your patience here. Copy link copied. Okay. All right. Here's a Google Drive link here in the chat for these handouts. So thank you for your patience on that. All right. So let me take a look here. Okay, just one more question in the Q&A here from Galen. What is your thought on the chances during Biden admin will remove step-on basis in 4 years? Okay, so there's a lot of talk of that. And the reason there's talk of that is the president, every president, has something called the Green Book. And it's because it's printed on a green cover. And I got a copy back there. There it is, Green Book. So that's when the president gives all his ideas on what the tax changes are. And if you read the Biden tax plan, and hold on, I'll put a video to that. Give me a second here. I'll put in the chat a link to a video on the Biden tax plan. So give me a chance here. I'll keep. Okay, hold on for a second here. Here we go. Okay, Biden tax plan. All right, so I'm gonna put in the chat my YouTube link to a video I did on the Biden tax plan. So it was recorded in October, but most of it's still pretty relevant. I mean, we have a little more information now, but this came from the Obama administration. So in the Obama administration, they were looking at eliminating the step up in basis. So they were looking at that. That went nowhere during Obama's term, and us tax people are suspecting it probably won't go anywhere here. It's it's like anything else, right? You put everything on the table, and then they become bargaining chips, and knowing that some ideas will never fly, and that's okay. So you can make the other side feel like you're winning. Hey, I'm gonna give that one up. So that's a bargaining chip. So I'm assuming it's going to be used as a bargaining chip because it's not going to go anywhere. Most Congress members aren't going to go for it, so it's unlikely going to have. Implementation's disaster, 1978 and 2010. Okay, let me share a story about that. So let's say we eliminate the step-up basis. You inherit grandma's house. Grandma, what did grandma pay for it? I don't know. You go to Zillow. Zillow doesn't show the purchase price because it doesn't go back to 1962. So we don't know what she paid for. We can't find the purchase document. It wasn't recorded back then. And, it's on microfiche. It's not on the internet, right? So in 1984, I worked for the IRS and I went through IRS training, and I still vividly remember what the instructor said. She goes, if you're talking to a taxpayer, they're teaching us how to audit people. If they cannot tell you what the cost basis is, if they cannot document it, just put down zero. Just put down zero. So I still remember vividly when she said that. So you got to be able to prove the cost basis. So, if any Congress members are affected by this law, they're going to change it. So I don't think it's going to happen. So anyway, it's at the top of the hour right now. And yeah, it went quick, didn't it, Kateryna?
Yeah, it went very fast.
Very fast. And where's the button for the chat? Here's the chat. I think we got, I think we answered everyone's questions. But thank you very much. Thank you, Kateryna, for hosting this. It's a very quick afternoon here. I hope this was helpful. I hope this helped enlighten you about what Prop 19 is all about. And I hope you make good decisions with it.
And Larry, before we sign off, I want to remind everyone that there will be another webinar with Larry Pond as a speaker on tax planning on real estate. And that one we already put on the calendar on May 1st. It will be Saturday from 2 to 3. So if you are interested, please make sure we have your email on file, and then we'll keep you updated on the future events.
Yeah, we'll update you to whatever the latest changes are then. There's a lot that can happen. We got tax season coming up. That's what's going to keep me busy. Kateryna's got a few houses to sell. That's going to keep you busy. But definitely, if you need help with your real estate, give Kateryna a call.
And then we hope to see you on May 1st to talk more about tax planning on real estate. And check out the videos of Larry on YouTube. They are very insightful and informative.
Thank you very much.